Hey, Michael, can you hear me? I can't hear you.
How'd you?
All right, I can hear you now.
There we go. How's my audio? I'm not in the studio. I'm in my office.
Hold on a second. Was about to take it live as I was testing stuff out. All right, I see you there. All right. I'm ready whenever you are. And of
Yeah,
course, there's going to be a delay. So
that's all good. Thanks for having me, by the way.
you're welcome. All right. We are live, but I'm going to take just a couple minutes here to wait for some people to jump on. Michael, could you still hear me?
Yeah, I can hear you fine.
All right, good. On the live, it looks like there's a delay, so it's just weird.
Gotcha. How's my audio? Because I'm not in the studio. I could go in the studio if you want me to, but
No, it sounds great.
yeah, I don't know if you've been watching some of my podcasts or videos that I put in the group and in the studio, but I've got all that fancy sound equipment and audio, and I'm not liking the quality so far. I gotta play with it and figure out what's up.
Hold on one second. I'm trying to switch screens around so I have live on one side. All right, I think we'll go ahead and get started. Today, hello, Trailblazers. Today we have Michael Lush of Replace Your Mortgage with us. And let us know if you are live by commenting live below, or if you watch this on a replay, of course, comment replay. And I will go ahead and give a testimonial, if I will, before you even get started.
Before you do that, I want to get in the Facebook group so that maybe I could see some questions too.
Okay.
And we can both kind of tackle if there are questions in there. So,
yeah, I have it pulled up on my phone, I think.
I am in there. So if somebody comments, I'll see it.
Awesome. All right. So my testimonial, I'm a client of Michael's and Replace Your Mortgage. And not only will I have my home paid off in 7 years, I was able to tap into some equity to fund some business growth. So I am so glad that I found Replace Your Mortgage. And it's actually been a big moment in my life to know that I could have my home paid off so fast. So without further ado, I'm going to go ahead and let Michael explain kind of the strategy and the benefits of it.
Yep. So Replace Your Mortgage, I kind of wish we could rebrand and do a different name, because when you say Replace Your Mortgage, people think that we're a mortgage company. We're not. We're actually the anti-mortgage company. And I say anti, I mean that with a grain of salt, because there are times that we would recommend a mortgage. But there are many times that we would recommend what's called a first lien position home equity line of credit. Now, this isn't for everybody. I have a business partner on the banking side that has a really funny saying that's one of my favorite, is this is kind of like yoga pants. Everybody can fit in them, but not everybody should. All right. And what I mean by that is this is for folks who have, for the most part, mastered their budget, right? So they are cash flow positive. Cash flow positive means there's that margin between what you got coming in and what's going out. And if you are healthy from a cash flow positive standpoint, a HELOC in first lien position, there's nothing that equals it thus far. And again, this is coming from a guy that spent 17 years in the mortgage industry, selling mortgages. So this isn't something I wanted to be true. Actually, when it was presented to me, this is not an original thought or idea. This was presented to me by a hedge fund manager. And I spent a year trying to prove him wrong, because if he was right, what I was doing was wrong. And actually, one of his quotes that stuck with me to this day, that was in 2009, he said it, but it has stuck with me ever since, was, Michael, respectfully, mortgages is selling financial crack to middle America. And that didn't sit well with me, because I didn't want to be a dope dealer, right? And if I was selling financial crack, well, I needed to fix that problem. So honestly, I tried to prove him wrong. I hired a CPA and an actuary. It's been a year trying to prove him wrong, because I felt if I could prove him wrong, then I could earn his his not only his business, but inside of his sphere of influence. And that was really what I was after, is the power of proximity. I wanted to rub shoulders with somebody who's worth hundreds of millions of dollars, now a billionaire. And if I could, win my way in by proving him mathematically wrong, then he's like, oh, that's a smart guy. Plus, I was selling mortgages. So I also wanted his business from that standpoint too. And that's actually how I approached him. So the way he came to be was he was a hedge fund manager, and that hedge fund had given money, pledged capital to the mortgage company that I was working for at the time. I was director of operations. And he was out of Connecticut, and his parents lived in the Nashville area, Middle Tennessee area. So he would come into town to visit his parents. He would spend time mentoring me. And that's when I took the opportunity to try to earn his business and say, look, let me get in your sphere of influence, because big mortgages equals big checks. And ultimately, you kind of by default own this company through your hedge fund. So we're going to scratch each other's backs. And that's when he told me, he's like, look, anybody of significant wealth does not do a mortgage. And I was like, what do you mean? He's like, well, we do a home equity line of credit in first lien position. And I'd never heard of that. I'd heard of home equity lines of credit, but not in first lien position. And he spent 15 minutes, not long. See, he had an agenda and a time schedule to keep. So he only would spend an hour each trip mentoring me. And he spent 15 minutes explaining it to me. And everything I'd been taught in the mortgage industry went out the window. I was like, there's no way. And he said that I assumed that they paid cash for everything, because you're uber wealthy, you just pay cash for everything. So absolutely not. We leverage. We're masters of our domain. We are masters of our budget. We're masters of finance. So through arbitrage, which is, think like a bank, right? That's how banks make money, is through arbitrage. They're no different. So they were using banks' money to grow wealth. And back to just the simplistic form of this, a first lien position home equity line of credit can replace your existing mortgage. Or you could use it to buy a house. A lot of folks don't realize that. They think that, well, I'm going to buy a house, I have to start off in a mortgage, and then maybe I could refinance that into a HELOC. No, you could actually purchase that home with a home equity line of credit. And at the closing table, instead of it being a mortgage, it's a home equity line of credit. But being in first lien position does a couple things, because a HELOC is a simple interest open-end line of credit, meaning money can move in and out freely, right? A mortgage cannot. So an example, let's say you wanted to dump all of your income into a mortgage. What happens before the end of the month? You realize you can't get your money back out, right? It's stuck in the bank's treasure chest. So it's time to pay your bills. You screwed yourself. You can't pay your bills because your money's trapped. With a home equity line of credit, you can dump all of your money into the home equity line of credit, and it's there accessible to you 24/7. So when it's time to pay bills, you just use online bill pay, debit card associated with your HELOC or checks, and just pay your bills directly from the home equity line of credit. And what that does is it gives you what I call 100% income utilization. See, a mortgage doesn't give you 100% income utilization because of the previous scenario I told you. If you dump all your money in there, it's trapped. So yeah, you could get 100% income utilization for month one, but month two, you'll never make that mistake again because you got to pay bills, right? But a HELOC allows you to do that. So you get the benefit of utilizing all of your cash flow to attack two things that are far more important than interest rate: time and balance. Again, because it's simple interest, when you put all of your money into it, the next day your balance is lower by however much money you deposited into your HELOC. I call it deposit. The bank would call it a payment. But you deposit 100% in there. The next day, the HELOC automatically recasts for free. Now, I say free because on a mortgage, there are certain mortgage programs where you can get it to recast. So let's say $100,000 fell out of the sky. Maybe you sold some real estate or something, and you're sitting on $100,000. You want to put it into your mortgage. You get, in some mortgage programs, you get 2 times throughout the life of that loan that you can pay hundreds of dollars to have the mortgage recast. And what I mean by is, let's say you had a $300,000 mortgage, you put $100,000 into it. If you don't recast it, what is your payment the next month? It's the same, right? Amortization schedule is the same. Nothing really changes. You just owe less, but you could pay hundreds of dollars to have that mortgage recast, which means your payment changes and your amortization schedule changes. Now, why do they charge for that? And why do you think they limit it to twice over the life of the loan? Because they don't want you to do it. It's pretty simple, right? Why don't they want you to do it? because they lose valuable dollars in interest. So with a HELOC, it does that every single day automatically for free. And what you'll see, and we can run through some calculations here in a little bit, but what you'll see is with your income, as long as you're cash flow positive, you are melting away what you owe on your home equity line of credit much, much faster than you would on a mortgage. Our average client is 5 to 7 years that they pay off their home. We've had one gentleman 10 months. That was the quickest that we've seen so far. So some are faster and some are slower than others. But if they're utilizing this as their primary operating account, a HELOC is far more efficient than a mortgage is. And if you want me to, I can even get into the history of this because I'm a bit of a historian when it comes to banking.
Yeah, please.
All right. So what I teach is actually older than mortgages. Now, we all know hopefully we all know what mortgage really means, right? It's Old French for death pledge. So mort, which is mortality, and engage, which is basically a contract. So this is a death contract, right? That's where the mortgage comes from. Yeah. So in this country, this is actually older than the modern day mortgage. So prior to 1913, this is how we financed real estate. So we talk about that generation prior to 1913, our grandfathers or great grandfathers that, they would buy a home and then have it paid off in 5 to 10 years. You probably heard those stories, right? There was a couple of reasons for that. Number one, they were a better generation. I'll just say it. They were savvier. They were harder working. They were more disciplined, but they had a tool that most Americans don't think that we have today. And that was the way a mortgage was structured then versus the way it is now. A mortgage then was open end, especially for farmers. So let's say you're a farmer, you owe $200,000 on a farm, which back then that's a massive farm, probably $10,000 on the farm, right? And you sell some crop. Well, you could deposit your income into the mortgage, and they would adjust the deed the same day and say, okay, well, now you only owe this, and you're going to pay interest based on that, right? And then let's say you needed to borrow, you could go back down the next day to go buy equipment. And think, so money could move in and out freely in a mortgage. Now, 1913, that changed. What do you think happened in 1913?
The Depression? Is that when that happened?
Not quite. That was 1929.
Oh,
close
right.
1913. I'll give you a clue. J.P. Morgan.
Oh, banks?
Federal Reserve.
Oh, right.
Yep. So a lot of people don't realize this. J.P. Morgan was the creator behind the Federal Reserve. So really good book out there. And it's really a biography. It's not something that's science fiction or fiction. It's true historical facts. It's called The Creature of Jekyll Island. So Jekyll Island was an island off the coast of Georgia that J.P. Morgan owned. And what he did is he had a secret meeting. Even the staff didn't know who the participants of that meeting were. So he had folks trained in, and there were 6 individuals in that room, politicians and uber wealth. J.P. Morgan at the time was the wealthiest man in the world. In that room, the combined wealth of that room, conducting this meeting, was 1/4 of the world's GDP. That's how wealthy they were.
Wow.
So what did they come up with in that meeting in 1911? A central bank. Right, central banks, it wasn't new at the time. There were central banks in London. I think it was Vienna, Rome. I'm forgetting my cities, but there was several central banks at the time. And we had tried to have a central bank in America in the late 1800s, but it failed. And why did it fail? It's because of Abraham Lincoln. And many people state that was one of the reasons that he was assassinated, is because he was anti-central bank. And if you follow the other 3 presidential candidates or presidents, what was their platform? They were anti-central bank. Again, historical facts. This isn't conspiracy theory. So I think it was
Interesting.
Garfield, William McKinley, and John F. Kennedy. So back to the story. So they create the central bank. What do central banks and the Federal Reserve do for our banks today? They are the backstop for banks. So they allow banks to execute something that is very powerful for banks. and that's called fractional reserve lending. Fractional reserve lending means that every dollar you deposit into a bank account, they have 10. It's called fiat currency, right? Where does it come from? Thin air. They literally just type a keystroke and boom, you got money, right? Hence why the value of the dollar has tanked since 1913. And, cost of goods, inflation, and things of that nature has consistently gone up. So banks looked at this and said, whoa, so for every dollar we get in deposits, we have $10. For every 100 grand, we have $1 million. For every million, we have 10 million to lend out. And the way banks make money is arbitrage. They have to lend money out. As soon as it comes in, they've got to put it in motion. They've got to lend it out at a higher rate than what it's costing them to bring in, right? Hence why when you deposit money into a bank account, what are they paying you in interest?
Minimal.
Yeah.
as little as they can.
So little, I call it 0%.
Right.
In some banks, it's not that small. It's like 0.17%. But no one would deposit their money into a checking account or a savings account and call it an asset or an investment. Why? Because look at inflation. Inflation is anywhere from 1.5% to 3.3%. So why would you put money into something that doesn't earn anything while the cost of goods and services goes up 10, 15, or 30-fold what you put your dollars in? So that's why I say a checking account and a savings account is really a liability. It's not an asset because your money is losing value. And it's so much so, let me give you an example. Let's say I give you $300,000. You put it in a tin can and buried it in the backyard. Because some folks think of their equity as appreciating. The equity doesn't appreciate. The home appreciates, typically, unless you're in 2008, 2009. Mm-hmm. But the cash that represents your equity is sitting in there at 0%, but it's worse than that. So let's just visualize $300,000 tin can buried in the backyard 30 years from now. What is the value of that tin can?
Still 300,000. Well, no, less. It's less because inflation and everything else.
$122,000, right? Mm-hmm. So your money vanished. It's the buying power of that money. It vanished. It's now only worth $122,000 because 30 years from now, it's not $300,000 isn't going to buy a $300,000 house. It's going to buy a $122,000 house, right? So back to the fractional reserve lending. So banks got together and said, whoa, this is a really neat magic trick. How do we get more what's called core deposits, right? Now, my history, senior vice president of Federal Savings Bank, director of operations for other banks, product development director for some other banks, and now I own a minority share of a joint venture in a publicly traded bank. So I'm in those board meetings, and I can tell you what the number one focus is in all of those meetings. Guess what it is? How do we grow core deposits? We need more depositors. We want more people giving us money so that we have more money to lend out at 5, 6, 7%. And that's arbitrage, right? And remind me to get back to arbitrage and how interest rates make banks extremely profitable. But I want to stick to this point because I have ADHD. And as you know, I don't medicate. So I'm a bit of a squirrel.
And I was just going to mention real quick, not to lose your train of thought. If anybody watching has questions, please post those questions as we're on the live. If not, if it's after live, post the questions, and I'm sure Michael will try and answer those.
Yeah, just tag me and I think I'm tagged in this post anyway, so I'll see it. But yeah, I'll answer those throughout the day. So the banks got together and said, we need to grow core deposits. So they made one simple change. They made a mortgage from an open-end loan, because people were kind of treating their mortgage like it was their checking account back then, to a closed account, meaning money can only go in but not come out freely. The only two ways to get money out is to refinance, which is thousands of dollars, or to sell your home. That's the only two ways to get access to your equity, or go get a home equity line of credit, right? So since money can only go in and not come out, now what are you forced to do with your mortgage? Adopt a payment strategy as opposed to a cash flow strategy, right? So a payment strategy means you're not going to dump 100% of your money into your mortgage. Now you're only going to dump a fraction of your money into your mortgage. You may pay extra if you're highly disciplined. Most people are not. And they don't, because they know that it's trapped. If I pay extra, what if I need access to those funds should an emergency come up? So they don't, right? They'll put it somewhere else, right? So money goes in, doesn't come out. So you're only putting a fraction of your income towards your mortgage, which does what to the mortgage? You owe on it for a longer period of time because you're not attacking it aggressively. Many folks thought that that was the single reason why they changed mortgages, was so that we were in debt longer and we paid more interest. That was actually the byproduct. That was almost by default or accident. The number one reason was to segregate your income. So if you can only put some money in and you have to leave money behind to pay your other bills and expenses, where are you leaving it?
In the bank.
In the checking and savings account.
Yeah.
So what did they just do? They drastically increased core deposits. So they forced consumers, hey, you can only put some towards your mortgage, but you got to leave money behind somewhere. Please give it to us, and we'll put it right here. Nice and safe for you, right?
Now we got all your money.
Yep. So now not only are you paying more interest over a longer period of time, but now you're not earning any interest on your money, and they get to execute what's called fractional reserve lending. So that was the singular focus of why the modern day mortgage came about. So what we teach is actually older than mortgages are. We're just going back to basics, and we're just trying to share it with one American household at a time. Now, interest rates. I didn't forget. Sometimes I impress myself. So typically I would have forgot, but I didn't forget this one. So interest rates. Let's talk about interest rates. So in 1981, interest rates skyrocketed, right? You had the savings and loan crisis. You had banks failing, like the Bank of Texas, Bank of West Texas, which was the Bank of America of its time, right? It was the largest bank in America, and it was going under, and the FDIC couldn't cover it. So bada bing, bada boom, you got the savings and loan crisis, and interest rates skyrocketed. Well, Greenspan, Alan Greenspan, not his father. That tells you how old that dude is, right?
Wow. Yeah.
He was the Fed chairman. He said, here's what we'll do. Because banks were lending money out at 18% and their cost of funds was 9%, right? So he said, we will drop the cost of funds to banks. So banks will now have a cost of funds of 3%, and now they get to lend it out at 9%. So the consumers are happy. Their interest rates just got cut in half. They went from 18 to 9, 10%, right? Now the banks were making double their money. So if you get money at 9% and lend it out at 18%, you've doubled your money. That's a 100% rate of return. A lot of people would think of that as it's a 9% rate of return. No, that's the margin. Don't confuse margin with rate of return, right? So substitute out the percentage with $1. So if I get $9 from you, Doug, and I turn around and give you 18 back, you doubled your money. That's what banks were doing at the time. But Greenspan said, let's cut interest rates to 3% cost of funds. And now banks lend it out at 9%. What is their rate of return?
I'm doing it's more than double. It's
300% rate of return.
Yeah.
So they've tripled their money. So think about what the banks did. They went from 100% rate of return to 300% rate of return overnight. That's how banks are profitable. And people wonder why interest rates have stayed low since then and continuously gone down since then. Now you've had these little blips or whatnot, but I mean, look at what we did over the last year and a half. Cost of funds now has gone down to 0%, but banks are lending out at 3 and 4%. Imagine the rate of return on that. It's thousands of a percent rate of return. Yeah. So that's how banks make money. Do you think banks want interest rates to go up? No, because as it goes up, they lose profitability too. And not just us as consumers on the consuming side. So that's how banks make money through arbitrage. They also do it through fractional reserve lending. And if you know these fundamentals and start thinking like a bank, well, then you start consuming like a bank. And that's what makes all the difference. So with a home equity line of credit, we're allowed to deposit 100% of our cash flow into it, knowing that we're 100% liquid 24/7. Should we ever need that for emergencies, it's there. But until we need it, it is suppressing the interest on that loan. And we're attacking time and balance. So there's the history lesson.
I was going to say this too about your company. It's not just a HELOC company. There's financial education as well. That's past that, which is really, really valuable. So once you tap into Michael and his company, you'll get more than just a strategy on a HELOC. So
again, that's why I need folks like you to help us rebrand, because Replace Your Mortgage has kind of got us pigeonholed into, we're a HELOC company. No, about 1/4 of what we teach is HELOC related in a HELOC strategy. The other portion is how to leverage that, right? I personally have leveraged my HELOC to grow businesses and invest in businesses. That's how I became a minority shareholder in a joint venture of a bank. Is I use my HELOC to buy into it, and now I get monthly dividends that I've already surpassed what my capital investment was in the first 18 months. And now it's just, I wouldn't call it free money. I have to work for it every now and then, but it was a great investment. Now, the other side of that coin is there are other businesses that were a dismal failure. So up until really locking arms with Nate and Edmund, who does our real estate investing coaching, I was like, real estate investing is easy. I got this. So I used my HELOC to buy a flip and didn't follow the strategies that they teach. And I lost 30 grand. It's not inside of my wheelhouse. So therefore I should stay out of this. But long story short is you can leverage your equity, to invest in real estate. You could leverage it to invest in businesses, or we've got some loons that do it in crypto, and hey, they do good. I'm not hating on them. It's just, again, outside of my wheelhouse. I wish I'd have done it. I will say that. I wish in 2017 I'd have dumped everything into Bitcoin, but hindsight's 2020. So you don't know what you don't know. But yeah, there's far more to us than HELOC strategy. My favorite is actually infinite banking concepts.
So the group is mostly entrepreneurs. I think it's all entrepreneurs. So there is a lot of value in having this education and this knowledge. So there will be a link to find out more information in the comments. And Michael, do you have anything else that you want to add?
What we still struggle with as a company is overcoming the thought process that this is new, or that it's a scam, or that it's too good to be true. Nothing could be further from the truth. This is something that is very common in normal outside of America. So Australia is probably the number one example of it. In Australia, 80% or north of 80% of citizens in Australia, this is what they do. I could not make a living going to Australia to teach this, because it's something you learn in high school and college. This is what the banks allow you to do. And they promote it in Australia. And what they call in Australia is they call it a money merge account. So the reason why it's a beautiful term for it, because it's merging two products into one. Your real estate loan and your bank account now become one product. So it's called a money merge account. So they're executing the exact same strategy of what I'm telling you now. And guess what? Australians have the highest rate of second home ownership. What I mean by that is they own two homes in less than half the time an American pays off one. Why? It's just a far more efficient strategy that's been under our nose for hundreds of years. I would say hundreds, about 185 years. So for 185 years, this has been under our nose. It's not promoted by banks. Banks are not going to promote this here in America. In other countries, this is popular. Regions, South Africa, Brazil, United Kingdom. This is popular. This is how folks finance real estate. Why is it that we don't in America? Because we primarily get our education from the financial institutions. And do you think it's in their best interest to teach us of how to pay less interest and deposit less money? No.
That part's a scam to me.
Exactly. Right. And I joke around, my father-in-law and I were having dinner one night, and he's like, man, because I got big goals. I really want to change the way Americans borrow money. And if I could get 10% market share, then I think that's the tipping point where this gets on the radar, and it's something that people have to take notice of, right? And if we change the way people borrow money in America, think about 2008, 2009. Do you think that would have been as devastating as no?
Nope, not at all.
And in fact, I'll if we've got time, how much time you got?
Yeah, keep going.
All right. So As you know, in my group, I talk about my affiliations with hedge funds and negotiating with them and leveraging them to buy paper and whatnot. So, we were in talks with several hedge funds a couple of years ago, and still to this day, some hedge funds, we don't need them as much as we did a couple of years ago. But what they informed us was there was some institutions that were doing this as a bank, and these hedge funds were buying up this paper in 2008 and 2009. In that time period, there was over 2,400 transactions of people that were doing first lien position HELOCs, right? Well, we all know that in 2008, 2009, rampant foreclosures. Lots of people lost their home. In the hedge funds a couple of years ago, it was like, we want to buy as much first lien position HELOC paper as possible. Where's it at? Where can we buy it? And I'm like, okay, that's interesting. Obviously, that's what I do. It's what I teach. But I'm just curious, why do you want to buy that paper? They're like, it's the best performing paper. We own paper in mortgages, and we had north of a 5% default rate. So lots of people were foreclosing, which they lose money. That paper doesn't perform. And we want to buy something to hedge against it, no pun intended. We want to buy paper to hedge against it that performs better. And I was like, okay, well, and we dug into the numbers. Like, what is the performance of first lien position paper versus a mortgage? They're like, actually, with this one institution, there are 0 defaults. To this day, that institution, those people utilizing a first lien position home equity line of credit had 0 defaults. No late payments, no foreclosures, nothing. Now let's think about it, why that was. If you have a home equity line of credit, let's say you're starting off at $300,000 and you're cash flow positive. Well, heck, within 3 years, you've got half of that sucker paid off, right? Mm-hmm. But you still have access to the other half 24/7. So let's say something happens, financial turmoil. You've got access to 150 grand at your disposal. And some of these HELOCs are mechanized so that if you don't make a payment, it's okay. You've got access on your line. We'll just add it to your balance. We'll just add the interest to your balance. Now, if you got 150,000 and your interest payment is $600, how long can you weather that storm?
Not
years.
Oh, yeah.
Years.
Yeah.
Right?
I was thinking about the traditional mortgage. You can't.
No. You don't make a payment on a mortgage. They're like Joe Pesci.
Right.
If you pay me, right?
Yeah.
That's not the way it is on certain HELOCs. If you don't make a payment, they just add the payment to the balance and you're not late. So you don't even have to make a payment on your home. It gets better than that. Mm-hmm. You can actually utilize a HELOC as a reverse mortgage. So a reverse mortgage, I'm going after the reverse mortgage market because I think they take advantage of senior citizens, 62 and over. Mm-hmm. They're extremely expensive. If you were a mortgage loan officer and you did a $200,000 reverse mortgage, your commission could be as high as 15 grand. Mm. Now, commissions don't come out of thin air. Where do they come from? Consumers overpaying. Mm-hmm. So the fees on reverse mortgages are extremely high. But there's one component of a reverse mortgage that makes it work. Guess what it is? A home equity line of credit. Mm. They all have home equity lines of credit in them. That's what's making the payments for you when you don't make a payment. So instead of going and getting a very costly reverse mortgage, you could have a home equity line of credit, and you don't have to be a senior citizen, and you set up your own reverse mortgage for free. So not only do you not have to make a payment to the home equity line of credit, it can start paying you as long as you've got room on that line. So it's something that you've been saving for a rainy day. If it rains, now you don't have to make a payment to it, and you can mechanize to say, hey, I need subsidized income. So I need the HELOC to start paying me $3 grand a month so I can weather the storm. And storms don't last forever, right? They always go away. Mm-hmm. So surely these storms aren't going to last for years. Maybe it lasts for 6 months. And you're in the group, in the Replace Your Mortgage private group. So we've seen some stories, about a half a dozen stories where either a spouse passed away, which is the worst, that nothing can replace that, but it happens. And also the income goes away. They've been furloughed. They've been laid off. Well, they've been able to weather the storm. And in fact, some folks have gotten so creative that they're like, okay, I got laid off because of coronavirus. So now I'm going to parlay this equity that I have to build a business and build some passive income and create their own economy, right? Yep. Which Amen to them. That's great. I mean, that's Americans, not Americans, right? That's what I love about that group. So they have been able to weather the storm for 6 months. And then once they get back on their feet, okay, then you get back to the strategy, start knocking it away.
And those that started businesses are better off than they were before. So,
right. Yeah. You've seen those posts.
Yeah.
So it's not just something that is beneficial to you in times of thriving. This can save your butt in times that you need to survive. So there's the upside to it, and even on the downside, there are some benefits to it.
This has been really, really informative, and I'm glad that you were able to come on because I love that the group gets to hear this. And
you have no idea what I went through to get here.
Oh, really?
Have you seen the weather in Tennessee?
Oh, is it? No, I have not. I just know about Oklahoma and Texas.
No. All right. So in Tennessee, and we're not prepared for weather like this. So we got pounded with freezing rain, sleet, and snow.
Ooh.
And the roads are absolutely covered. And at my house, the internet is absolutely atrocious. You've probably seen me do some lives and whatnot at my house, and it's like, it's bad. I got really bad internet because I live out in the sticks. But I'm a country boy, and country boys got 4-wheel drive. So I got out in it and made my way here so that I could have high-speed internet in order to do this.
Well, I appreciate you. You could have, if you needed to reschedule, I would have definitely done it. But I'm glad that you made
American, not American.
That's right. You're not trapped to the office now, are you?
No, I thought I was going to be yesterday because I came in yesterday. So I went out and I had about 2.5 inches of ice on my truck, and that happened in a matter of a couple hours while I was here. So I had to spend some time de-icing my truck like it was a plane in order for me to drive out.
Wow. Well, once again, thank you, Michael. And like I said, if you have any questions, whether you've watched this on live or you're watching our replay, please post those below, and Michael will see those. And once again, there will be a link to get more information also in the comments. So if you want to get more information, just click on that link. And I'm so glad that we did this. Thanks, Michael.
Absolutely. Anytime. Thanks, Doug.
You're welcome.